Hello, good afternoon. Uh, I think Harshil was supposed to do this webinar, but today I'll be taking over. He's stuck in another meeting. So, no, I'm sorry to keep everyone waiting. I think we're already running 5 minutes late. So we'll start without further ado. Part of the reason why we wanted to talk about tariffs is because it's been in the headlines a lot, and it seems like there are a lot of things that could impact uh, the way that we look at markets, the way we look at global trade, and the effect of tariffs is quite long winding. So when we take all of this into consideration, I think that was the rationale behind keeping today's webinar surrounded by the impact of the tariffs on the Indian market. So we'll begin. The structure of our webinar is we will cover certain data points that we have in the first part. And if you have any questions as and when they arise, please feel free to put them into the chat box. We do have a dedicated section for Q&A towards the end of the webinar as well. All right. So let's first try to understand what a tariff is, right? A tariff is essentially a duty that you impose, which is a kind of tax that you're imposing on any good or service that comes in from another country. Now, this is a source of government revenue, and I think the basic reason why tariffs have become a negotiating tool or have become front and center of US policy making is because there has been a need to sort of raise government revenues there. We've all seen how the US's fiscal deficit has played out, how they've been on a borrowing path, and there is a need to sort of repay that debt. So, from a government revenue perspective, tariffs could be a great tool in sort of achieving that target. Now, historically, I think there are two timelines or two key events that we should sort of study a little bit to understand the impact of tariffs. The first, of course, is the Uruguay Round. This took place in the mid 1990s. And behind this, the basic idea was that countries started negotiating and bringing down tariffs. And Uruguay Round was actually quite effective in bringing down the tariff rates on agricultural as well as industrial goods. So, over a period of 7, 8 years, they were able to eliminate tariffs on certain industrial goods altogether. So, there was a gradual tapering down on the tariffs there. The Doha the Doha Agenda, on the other hand, was not as successful. It started in the 2000s and it's still unfinished. So the negotiations haven't really clicked through, but the success of the Uruguay round created room for a much more globally integrated economic system, and it also lowered tariffs on a lot of goods over a period of time, and this resulted in better and more healthy global trade. Now the situation that we have entered into is a phase where tariffs are more protectionist in nature. When you do impose a tariff, what you're doing is you're sort of putting a penalty on goods that come into the economy from outside, and you're trying to promote what is homegrown, right? Now, this can be an effective strategy if homegrown goods can offer the same quality at the same cost of production. But if there's a compromise on either pricing, meaning you pay more, or on quality, then there is going to be a second order effect that you have to consider. So if you're not able to produce at the same cost level, then imposing tariffs actually creates an inflationary effect. At the same time, if you're not able to maintain the quality, then people might be willing to pay more for quality, which also creates an inflationary effect. So, keeping this as the tariff context in mind, we can start talking about what the US policy has been. So, there's a simple formula to sort of calculate the reciprocal tariff, right? The idea is that your tariff rate should be a negative half into the exports minus imports by the exports of the country. So when you do this, you kind of look at your trade deficit versus your trading partners' contribution to your economy, and then you try to find a level which is fair. So the basic idea here is that you're looking at how much somebody is contributing to your trade volume, how much you are contributing to their trade volume, and trying to find this number that would sort of equalize the amount that both parties are paying in terms of taxes. So, this is what Trump has really been trying to do. He's been trying to say that, you know what, we are actually buying a lot more from the rest of the world. So, if we're buying more, then you need to sort of we need to earn some money on that, on the goods that we're buying from you. So this essentially is the entire reciprocal tariff game that he's been trying to do, and the negotiations that they've been trying to push forward. Now, I think a couple of months, I mean, it has been a couple of months of uncertainty, but this news broke out in January. Then we knew that July was an important deadline that got pushed to August. And as far as India is concerned, we were originally slotted for the 25% tariff bracket. And that our negotiations didn't really go through because the kind of compromises that the US was expecting in terms of trade were not something that we could really agree upon. So then we got slapped with a 50% tariff, and now again negotiations are back on the table. Again, in the US, there's a lot of question about whether what Trump is doing is constitutional or not, because economic policy or tariffs are specifically a power of the Congress and should not be something that the president can negotiate. So parallelly, I think this is going in many different ways, and much of what's being said in the headlines is not really what you're seeing on the ground reality. But that being said, let's look at what the impact of these tariffs could be. So if we look at India and the US, we have actually been able to export more over a period of time, right? So I think US accounts for close to 20% of our exports, and they are the single biggest importer for Indian goods, meaning for us, they are the number one trading partner. So when we look at what's going on here, if we see, let's say, how many $billion we were exporting to the US. In FY24, this was around $78 billion. And then in FY25, it climbed to 86 and a half, right? And if we look at the first 4 months of FY25, that number was close to $27.5 billion. Whereas if we look at the first 4 months of this year, then we've climbed up to $33.6 billion, right? So clearly, like, we have been sort of exporting more to the US during this phase. And even when we had uncertainty in July, meaning we didn't know where the tariff number was going to go, we did have a higher export that's gone in there. At the same time, if we look at imports from China, UAE, the US, and Singapore, which is the chart on the right side, and I've highlighted this number for you, you can see that we've also started importing more from the US over a period of time. So this is essentially a result of the negotiations that have come forward, because the idea is to do more business. And as you do more business, then your reciprocal tariff rate comes down. But certain things that the US is asking for are where we're not able to see eye to eye. So that being said, like, if we look at what our trade surplus has been, this has almost gone 2 times in the last 10 years, right? So we started out in, say, 2012 with export surplus, or your balance of trade, at like $20 billion. And then this has gone up to almost $50 billion now. Now, if we look at, which countries export to the US a lot, there's a high dependence on the US economy for countries like Mexico and China, where you can see most, that is like more than 3/4 of their trade is done with the US, right? But if we move down to India, our number is high in the sense US is still the number one trading partner, and is our largest export market, but we're not so dependent on the US, not as much as, say, a Mexico or a Canada. And China actually ranks even better where US only accounts for 12.5% of trade. So when we think about where tariffs are heading, and if tariff negotiations stall, then what will happen is that you'll see a realignment in terms of finding other export markets. You'll also see better sort of trading strategies with the US. So if you see, we are trying to buy some oil from them, we're trying to do certain other things in terms of bringing your export minus import, that is your difference, down over a period of time. So now let's look at the impact of tariffs. I think sectors that are not really going to be affected or that have always been outside of this tariff net have been pharma. You've also had IT services as well as fuel outside the net of tariff. So regardless of how the negotiations go, these three sectors have sort of been clearly sidelined. Now, there's been a lot of talk in and around pharma in terms of how this goes. And if we look at high risk sectors, I think for us, gems, textiles, organic chemicals, machinery, these are the sectors that are going to be broadly affected by the US. Because now, if you see what US is a high share. So if we look at, let's say, apparel and textiles, more than 30 to 50% goes towards the US, which means we are heavily dependent on the US for trade in this segment. At the same time, the new tariff creates a significant shift, right? So the original tariff holds good. So we were tariffs, textiles were trading anywhere between 9 to 14%. Now the new tariff adds an additional 50% here. So then you're actually going to have your tax hit at maybe 60-65% of the product that is produced, right? So this essentially means that you cannot compete with other markets at all, because even if you are the best producer at the starting cost, your goods are going to cost 60% more than other goods, right? So then automatically there will be a shift that happens in terms of prioritizing India versus other economies. So this will make it unviable for the export, for the textile sector to really export to the US, because you can't compete in that market. Your goods are going to be priced too high. Whereas, like I mentioned, you have petroleum products, pharmaceuticals are kind of completely exempt from the new tariffs. So this is really not going to add anything here, and it's going to keep you competitive in that segment, right? So this, if you want to look at some of the other items, like if you're looking at furniture or if you're looking at gems and jewelry, again here your previous tariff was around 2%, and now you're jumping to 52%. That's a huge change in terms of how much tax a US consumer is going to pay for your goods, and that will make your goods sort of unviable to sell in that market. So, what has the impact of tariffs really been? So, if we look at the monthly exports for this financial year starting in April, there was some, so Q1, you can clearly see there was some push to sort of get exports going. But the minute you had your uncertainty settle in, there's been a steep drop in the export level. So, we've gone from, say, a peak of 8.75 billion dollars in May to now sub six, maybe 6.75 billion, right? So this essentially says that tariffs have created a lot of uncertainty around businesses being able to plan deals with the US. It's also going to create second order effects in terms of inflation, in terms of quality control for the US as well. So this isn't like a one-way impact. The impact, when it's negative, is actually going to hit both economies. And where we are today shows that that both countries are moving towards better resolution from where we stand. So this is a chart which quickly kind of shows you what's the impact of tariffs. So we have a trade surplus with the US when it comes to machinery, chemicals, and textiles, but these are labor intensive uh, sectors, right? Which means that if the US wants to replace India, then to manufacture it locally is going to cost them a lot more. So that doesn't seem like a very viable option. The second thing is, let's say in a space like pharma, you cannot really go down the quality ladder, right? So there is a need to sort of revisit this. At best, they could look at another market which is more competitively priced, where there is a lower tariff on the goods, which is what where you can see some trade move away from India to other countries. Um, so if we look at where the US has a trade surplus, this is in minerals, transportation, and fuel, and this is where they've been trying to negotiate also more. And the other segment, of course, is defense. So you are seeing two things, right? So you want, and they have been trying to push auto, but I don't think auto is really working out in that space. So this is where we need to sort of see what can be done versus what cannot be done. And I think agri is one segment where India does not want to trade more with the US or deal with that, because that would really affect a lot of what is happening locally. All right. So if this goes on and we end up paying this 50% additional tariff as over and above the existing rates, then I think this impact could be almost $18 billion. And this would affect our GDP growth by roughly 0.5%. Right. So the estimates on this really vary depending on how we make up for it, but it can be anywhere between, say, 0.2 to 0.8% in terms of estimates that different economists are projecting. So I think it's fair to say that roughly 0.5% of GDP growth could take a hit because of what's going on the tariff front, especially if you have some level of resolution, but not a full level of resolution. Now, coming to Indian markets and equities. So, if you want to find a reason not to invest, there are plenty, right? And time and again, depending on when you started or what you've done, there's always been a reason not to participate in the uh, markets, right? So this year itself, we've had so many things. We've had US tariffs dominate the headlines. We've had a border skirmish with Pakistan. We've had FII selling. We've had Israel Palestine tensions flare up. So there's always something that's happening which kind of scares investors out of the market. But maybe if we just flip that and realize that, okay, these things happen, but the market just moves up anyway. And there are good places to invest. There are always good places to invest. Maybe everything doesn't work, but something will definitely work for an investor. And again, this is an interesting data point from Funds India, where it says that, okay, forget about the crises. When you look at what is going on in the last 40 years, if you compounded at 12 to 14%, then you would have grown 150x, right? So it's not about thinking about the one-off events that are there. Of course, we need to be conscious about the crises, and we need to stay away from things that could end up uh, be problematic, but there are opportunities. We just need to look away from the herd. And if you're open to a more contrarian approach, especially when it comes to multi-asset investing, then I think Neo could do a lot for you. And lastly, just to look at India valuations, because this is a webinar that we're orienting towards non-resident Indians who might be considering investing in India or elsewhere, right? So Indian markets are actually not that expensive. So if we look at our forward earnings, we're roughly at 19 times, which is not very expensive for a large cap emerging market kind of strategy. And we are only trading at a marginal premium to the 5-year rate, right? Uh, so this is something that we need to keep in mind, that markets are quite attractive. And if they are attractive, then this is the time for you to sort of really look at positioning and uh, building your India allocation. So moving on to the think tank from Neo. So what is our investment framework? So we don't really have any cap on asset classes. This allows us to participate in different assets at different times and align our investment strategy with what the market is offering as an opportunity, right? We do both top-down and bottom-up research. This means that we have a macro proof portfolio, but at the same time, we are not missing the micro opportunities either. We run a concentrated thematic portfolio, which means we're looking at market leaders, we're looking at themes that can perform on a 3 to 5 year basis, and we're investing in those themes aggressively. So when we look at a thematic idea, we try to look at what's the best way to sort of achieve this output, right? So let's say we're looking at top-down opportunities, then we need to decide whether that top-down opportunity deserves an active strategy or a passive strategy, right? So when we recognize that it's an active strategy, we would look at direct equity. When we decide that it's going to be a passive strategy, let's say if we're positive on a particular global market, then you will see us participate through global ETFs. If we look at more bottom up, then this is always going to be active rather than passive. And here we have direct equities as a source to sort of achieve that. So I'm going to walk you through one thing that we did in our multi-asset product. We started, so this is from Sphere. Neo follows a very similar strategy. So we started our buying in 2021 for public sector banks. Our basic thesis was that bank balance sheets had improved significantly. Public sector banks had been recapitalized also in that period. They went through a phase where there were a lot of cleanup in the balance sheet level. You were reporting NPAs. So your profitability, everything had sort of bottomed out because the quality was improving and the results were not yet visible. So we felt that this was a top-down trade, right? We knew that there was a policy change in terms of the insolvency and bankruptcy code, in terms of the RBI reaching out and telling banks that they needed to like tighten their quality norms, they needed to tighten their reporting norms. So all of this was flowing in from top down. And we realized that it's not one or two public sector banks that are going to benefit from this. It's actually the entire pack because the mergers, the recapitalization, all of this was favorable to that sector as a whole. It wasn't just one or two banks that were benefiting from these regulatory changes. This led us to look at a sectoral ETF that would have allowed us to do this. So what we did in Sphere was, and this of course is from the time we were at PMS, but even prior to that, we were participating in PSUs as well as public sector banks as a theme. So we continued to buy for a period of 1.5 years, and we saw an opportunity to book out profits once in this period because you saw a run up in what was going on here. And then we took about another 6 months or so to exit this theme, right? So the exit was gradual over a period of time and we tapered it. We enter as well as exit themes a little bit earlier. So PSBs continue to perform even after we exited. But the idea here is that we're a very value focused portfolio, right? Which means that we're going to buy at the right time. We're not going to wait for the peak. We're going to exit when we see valuations have been fairly attractive and are fully priced in. So this shows that there's a process to what we're doing both in the buying as well as the selling. So if we look at how we can unlock prosperity, right? When I said that the portfolio is macro proof, we really want to think about how macros will play out in the portfolio. So if we see that, we're in a high inflation, high interest rate kind of era, then we know that fixed income is going to outperform, and there's a way to build that fixed income allocation over time. At the same time, if we saw that we were in a high growth earnings re-rating era, so let's say if we look at say 2021 to 2024, we did have higher growth, we did have earnings re-rating, and we had a much higher allocation to equity in this phase. It's only from 2024 that we started building the fixed income as a more defensive layer as your macro sort of shifts. When we get into a lower growth environment, then you need more of a dynamic strategy. So if you see our performance numbers as well, it shows that we've played this multi-asset strategy really well. We've bought precious metals at the right time, we've been more defensive at the right time, and this has resulted in better outcomes for every investor. So a quick look at our numbers. NEO's inception was in October 22. So we've only completed 2 years so far. And if we look at our since inception performance, it's been close to 24%. The last 1 year, it's been about 11%. And like I mentioned, the precious metal call has really played out. So if you see the 6-month return, a lot of that has really come from there. And when we compare NEO performance to the benchmark, especially in the longer run scenarios, we've been able to really beat all the benchmarks that we've set, even if we look at, say, industry leaders on the multi-asset space, or if we look at dynamic asset allocation funds as a category also. So what is our drawdown like? So NEO actually has been able to beat the multi-asset index also in terms of the downside, and beat the Nifty also in terms of downside. So there is much more downside protection and upside performance that a NEO investor can experience. A quick look at our performance data from 2025 August. We are still a broadly equity heavy portfolio. We have been constructing and slowly building the debt allocation as well as the precious metal allocation. So we have a fantastic team in terms of fund management. We have a very dedicated fund management team. We have strategists as well as research analysts who are putting in a lot of effort to make sure that these products get the best ideas to investors at the right time. So where do we sit in terms of risk? I think NEO being a multi-asset product would be somewhere between conservative and moderate in terms of risk appetite. The basic idea being that yes, it's a multi-asset portfolio, but we are also taking more concentrated thematic bets within this, which essentially means that it can be a little bit higher risk than what most people. It can be better than a conservative product or higher risk than a conservative product. Right? So this is where we are. We have a truly flexible mandate, like I mentioned, meaning we can go 0 to 100% in any asset class or instrument that we choose. We operate on a fixed fee model. There is no exit load, and this essentially means that any profits that the investor makes over and above the return expectation is theirs to keep. We are a SEBI registered PMS, which means that the minimum investment would be 50 lakhs. And we would recommend a multi-asset product for anyone who comes with a 5 to 7 year horizon, basically because in this timeline, you can actually experience asset allocation in action. If you come in with a shorter timeline, then it's unlikely that you'll really be able to see a full cycle of anything.